If I'm still bullish on Google, why did I completely close my put credit spreads, but keep my longer term leaps positions open? Well, that might sound contradictory, but these two positions were never open to do the same job. One was designed to collect shorter term premium with defined risk. The other was designed to give Google a substantially more time to make a larger move. In this video, I'm going to go over the actual chart I used, what caused me to enter the trade, why I took profits at two different levels, and why I'm closing one bullish position did not mean that my bullish Google thesis has changed. The larger lesson is simple: same stock, same general thesis, but completely different exit plans. Before we go any further, this video is for educational and informational purposes only. I'm not your financial advisor, and nothing in this video is a recommendation to buy, sell, or trade any security or strategy. Options involve substantial risk and are not suitable for everybody. Please do your own research and make your own decisions based on your goals, your risk tolerance, and your financial situation. All right, let's begin where these positions stood when I recorded this update. Google was trading approximately 356.13. My put credit spread positions were completely closed. I bought back half of the spreads at a 55% realized profit. I bought the second half back, or the remaining of them, at approximately 75% realized profit. My longer term Google Leaps position remained open and was sitting at 47.53% unrealized gain as of Friday. The word unrealized matters. The value of these leaps positions can still change because the trade remains open. The credit spread profits are realized because I bought those credit spreads back and closed the position. My bullish thesis on Google remains intact. What changed was that the shorter term trade I had already placed did the job that I wanted them to do. So I got out. All right, let's go back to the original chart because I didn't enter Google simply because the stock dropped after earnings and suddenly looked cheap. Google had a harsh post earning reaction and fell into the area where I saw several forms of technical support coming together. So the first important level was at the point of control, which was approximately 318.72. For anyone unfamiliar with volume profile, the point of control represents the price where the greatest amount of trading volume occurred within a measured range. So that can become an important area of support or resistance because there's so many buyers and sellers that were previously conducting business there, right? Remember, you're always playing against the person. The charts tell you what people are doing, even algos. But Google was also testing this area at its 200-day exponential moving average as well. So the 200-day EMA is widely followed longer-term trend level. However, neither the point of control nor the moving average would have been enough by itself. What interests me was the confluence. We had post earnings decline, the point of control, a 200-day moving average, and the possibility that the sellers were beginning to get exhausted themselves. But I still didn't enter simply because Google, touched support. I waited for a confirmation candle. I wanted to see if buyers responded. The stock held that important area and began moving back up from my signal candle. The entry was approximately 324.69. The original invalidation area was approximately 318.72. Now, if Google had broken that area and failed to recover it, the setup would no longer have been behaving the way I wanted. So the for the short term income trade, I used September 18th, 300, 290 put credit spreads. Now, that means the short put was at 300, while the protective long put was at 290. The protective put defines the maximum risk in these trades. I've made videos on put credit spreads before, so you can check back into my library and find that. But those strikes were also positioned beneath a support level I had identified on the chart. Now, that gave Google some room to move around without immediately threatening my short strike. My first upside target was 350, and Google reached that target and then continued moving higher. So at that point, the first half of my spreads had already reached a 55% profit. As Google continued running, the remaining half reached approximately 75% profit. I closed the rest out of that spread position. So the next levels shown on the chart were not automatic exits for me for my leaps position. There are areas where I will stop and evaluate what Google's doing. Okay, so I'll examine those levels more closely um, near the end. The put credit spreads and the leaps position both expressed a bullish opinion on Google, but they had two different, completely different jobs. The credit spreads were designed to produce short term income through a premium collection. They had defined risk, limited maximum profit, and a specific expiration date. Once most of that available profit arrived, the purpose of the trade had largely really been filled, right? The leaps position was designed to participate in a potentially much larger move over a much longer period. I still had roughly a year remaining, given the broader Google thesis substantially moved for time for this to develop. That distinction matters. Before entering any position, you should know exactly what position it is supposed to accomplish. What is that trade? What are the map, or what are the rules? Your entry, your exit position. You should know this before you put on the trade. Okay. Otherwise, when you it starts making money, you won't know whether you should close it, trim it, roll it, or give it more room. Same stock, same bullish thesis, two completely different jobs. All right, now let's talk about the 50% profit level on my credit spread. So there's nothing magical about exactly 50%. It's a management area, a decision point. It's not a command. When a credit spread becomes profitable, a large portion of the available premium is already has been earned, right? So, however, the possibility of the trade reversing has not disappeared. The risk is still there. At that point, I have to ask whether the remaining potential profit is worth continuing to expose that accumulated gain to the market. The speed of the profit is what matters to me the most. In this case, that first 55% arrived in a few days, really. When the shorter term position delivered that much profit that quickly, I typically begin to take that win. I don't need to squeeze every last penny out of a trade. Closing a profitable spread releases the capital, eliminates the remaining position risk, and gives me the ability to evaluate another opportunity with that money. I can always enter another trade if Google, gives me another favorable setup, though. So that's why I scaled out instead of making one all or nothing decision. My first exit came at 55% realized profit. That was right around my normal management area, especially considering that the proof arrived in only a couple of days, a few days. I collected part of that win while allowing the remaining portion of that position to continue working. So Google then moved higher, and the remaining spread reached approximately 75%. At that point, I closed the rest. The profits were realized, the capital was released, and the short term trade had completed its job. So closing these spreads didn't mean I was suddenly became bearish on Google. It just meant that I was satisfied with the result of a particular strategy. If Google pulled back, consolidates, or creates another favorable setup, I can always evaluate another position. Closing a winner today doesn't prevent me from entering another trade tomorrow. In fact, I very rarely keep my credit spreads above 80% wins, unless it's, I don't know. There's times when a stock can run, and just go crazy, and it's like, all right, you might as well just hold on to it because you're you're almost guaranteed. I mean, you're never guaranteed, right? But you're almost guaranteed 100% victory as long as I don't need that money for any other reason. But typically, when 80% of the profit is realized at any point in the trade, I usually get out because I'm not going to keep, my money tied up for that little bit of 20% and keep the risk going. So that's why I usually get out. Some people may ask, why didn't I keep a runner? A runner can make sense when you want to retain a small amount of exposure after taking most of your position off. But a runner is an option, it's not an obligation. I had already closed half the spread position at 55% profit. The remaining portion hit my 75%. And this happened very quickly, inside of a week. I was happy with the return and wanted to release the capital. Most importantly, I still had bullish Google exposure through my longer term leaps. I didn't need to keep a credit spread open merely for the sake of saying that I kept a runner. And honestly, in credit spreads, keeping a runner isn't necessarily the best choice because you're capped on your upside profit. You can only make what credit you received. So there's not much of a runner if you're closed out. You're already at 80%. Your runner can collect another 20%, and that's really about it. So you have to weigh the pros and cons. And like I said, usually at 80%, I'm out. And if I get fast moves, sometimes I'm even out in 25%. If I get into a put credit spread and I'm up 25% that same day that I put it on, I'll get out. I'll wait for another pullback and get back in. I mean, these are things that you can do to basically increase the amount of profit or position size that you're in at any given time. The leaps positions get more room because it was built for a larger potential move. It still has roughly a year remaining, and the long term Google thesis has not been invalidated. But more time does mean more. It doesn't mean that there's no risk. It just means that these leap positions can still lose value because of a decline in Google. Changes in implied volatility and the continuing passage of time. Theta is not your friend when you're in a long term options play, when you're buying. My plan is to manage the position primarily from Google's underlying chart. I don't want to react blindly to every temporary movement in the option premium. Longer term options can have a wider bid and ask spread, and I don't want a temporary fluctuation or a poor fill making the decision for me. Okay. I'm watching Google's price structure, its important support levels, and whether the original bullish thesis remains intact. As the stock reaches my next decision area, I can evaluate whether to continue holding, protect more of the gain, or potentially roll the position. Um, the important point is that I'm managing the leaps according to the job it was open to perform, okay? Not according to the exit plan of the credit spreads. All right, now let's look at my current Google roadmap. This is for people following along, or if you're looking to potentially get into trade yourself, maybe. So the first target near 350 that's already been reached. My next decision area is approximately 361.47. You can always go back to the area where I have the chart, and you could study those levels. You can take a screenshot so you have them if you want. But after that, I'm watching approximately 373.53 as my second target. followed by 391.37 near the long-term value area high. Again, value area high, point of control, value area low. These are all volume profile uh, terms. Um, you, volume profile is something you definitely want to understand if you're a trader or even if you're just investing. The value area high represents like the upper boundary of the high volume area where uh, people were shown to be trading. These are decision areas. Um, they're not automatic exit orders. When Google reaches one of these levels, I stop and reassess the position. I evaluate the chart, right? The remaining time, the value of the option, the conditions of the broader market, and whether the original bullish thesis is still working. So, depending on those conditions, I can continue holding, protect more of the gain. I can put stop losses on. I can roll the stop losses up. We could trim the position if we want. We could take off, a couple of our positions or whatever, and you could potentially just roll it. When you roll it, you're locking in profit, and then you're opening a new position at a higher strike price at a longer dated return, a longer dated point, and you use some of those profits if you need it to get into a more favorable position. Uh, but usually, most of the time, when you roll a, a position up because you're in profit, you're actually locking in that profit. I ultimately believe Google can challenge its previous highs and honestly potentially make new highs within the terms of my long-term thesis, which is about a year. Um, but believing that it's possible doesn't mean I ignore any kind of risk or assume the stock will travel there in a straight line. Volatility is always going to be present. That is the real lesson from this trade. The credit spreads and the leaps positions can be based on the same bullish thesis without sharing the same time horizon, same profit targets, or even exit plan. Let me know in the comments how you manage profitable credit spreads. Do you normally close them around 50%? Do you scale out like I did, or do you try to collect a larger portion of that available premium? If this video helped you, please hit the like button and subscribe to Practical Income Investing. And take a look at the video on the screen now, because the next investing decision always begins with continuing to learn. Thank you for watching. We'll see you in the next video.